So what we need to do here, we need to, in case of right issue, we need to consider two things. One is that we would be considering the time period for which we have received the cash and we invested it, and the cash made some earnings, but those earnings are only for 3 months. So therefore, we need to use the average number of shares. And the second thing which we need to do is that we need to include the bonus element as well. That although we received cash, but we did not receive the full cash, we received slightly less. So we need to include that impact as well. Sure. So we are going to incorporate in right issue. Calculation will be slightly difficult, but if you understand the concept, then it will look easy, because we are going to do two things: weighted average and the bonus concept. So it says that when an entity wants to raise additional finance, it may choose to do so through a rights issue. Right issue means you are issuing the shares at not full market value, but slightly lower. Here, existing shareholders are offered the opportunity to buy more shares in the entity. So it is not given to outsiders. Outsiders, we always give full value. Existing shareholders, we may say, okay, we are giving discount. The price they will have to pay for the shares, the right price, will be lower than the current market price in order to encourage existing shareholders to subscribe to the right issue. Because we want to maintain their holding, we want to maintain their control. Because if you start giving shares to outsiders, they lose control, and dilution of ownership happens. Consequently, a right issue includes both an issue of shares at full price and a bonus issue. So you are giving at $4, so you are getting cash, and you're also giving away some bonus. So here, right issue of shares, again, fair value per share immediately before the exercise of rights. We call it TERP, theoretical X right price, divided by TERP, theoretical X right price. Now, what is TERP? TERP is an important concept, but very easy. Let's suppose that your current market price of share is $5, and you say that we are giving right issue of 1 for, or let's call it 2 for 5, 2 for 5 at $4. Which means anybody who has 5 shares will get 2 new shares for $2. So what was your situation before? So you had anybody who had 5 shares at $5 will get 2 new shares at $4. So this makes 25, and this makes me 8. So it becomes 33, and number of shares are 7 now. So 33 divided by 7. Can somebody give me the answer? What is the answer? 33 divided by 7.
4.71.
4.71. Now this 4.71 is called TERP. TERP means theoretical X right price. So it's not market price, it's theoretical. I've calculated it based on some mathematical logic. Before my price was 5. Before the right issue, market price was 5. After the right issue, market price will be 4.71. And how do we calculate it? Old number of shares multiplied by the old price plus the new shares which I'm giving as right to into $4, the price which I'm offering $4, 33. So we will say that the shareholders will now have, anybody will have 7 shares in hand, and their investment is 33. So if I divide 33 by 7, it makes 4.71. So shareholders will be even, for them, the value of each shares becomes 4.71. They can sell at 4.71 now. And this is one perspective from the shareholders' point of view, that if you ask them that if you want to sell, they would say I'm selling it for 33 because my initial investment was 25. I got 2 shares worth 8, so it is 33. And for 33, there are 7 shares in hand, so each share 4.71. From economics point of view, because the number of shares increase, supply increases, price goes down. Anything which supply increases, value, price goes down. This TERP is theoretical. It is just calculated on paper with a mathematical formula. In market, in reality, it might be 4.5. It might go to 5.2. I'm not sure. How much it will be in market, I don't know. But this is what I say mathematically, that we call it that after right issue. Will the price fall down? Yes, it will fall down because the share price was 5. Company started issuing at 4. So when the business started issuing at $4, the market price is expected to go down. So how much it will go down? It will go down to 4.71. We call it TERP now. So right issue, continue. The easiest way to see how the theoretical X-right price is calculated, this is the same thing they did. Okay, assume a company makes a right issue on a 1 to 4 basis. The share price immediately before the exercise of right was $10 per share, and the right price is 6.5. So they are giving 1 share for every 4 share held at 6.5. Previous price was 10. So 4 into 10 is 40. 1 into 6.5, 6.5. 46.5 divided by the total number of shares, which is now 5. 9.30 will be your TERP. TERP is rather simple, no difficult calculation. So bonus fraction now, right issue bonus fraction we need to understand. We remember the word bonus fraction we used and reciprocal of the bonus fraction. So bonus fraction is what? Bonus fraction is that before the share was 10, now the share has gone down to 9.3. Why it has gone down? Because from 5, you issued it at 4. Or maybe the share price was 10, you issued at 6.5. So because you give some bonus, because you give some, how to say, discount, as a result of this discount, the share price has fallen. And what is the percentage of that change in the share price because of the bonus? If the share was $5 and I'm issuing at full price $5, market price will not change. Market price will remain same. The market price only went down because it was 5 and I started giving it at 4. Or it was 10, I started giving it 6.5. So this was the reason. So how much impact it has created on the share price? On the share price, it was 10. In this question, we said that before right issue, the share price was 10. After right issue, it is 9.3. And this 9.3 is TERP, theoretical X right price. And the reciprocal, we also need reciprocal. Reciprocal is 9.3 divided by 10. And this reciprocal we need to restate the last year EPS. We need to restate last year EPS. So if I see like this here, exam question on this topic can be reasonably straightforward if you approach them in a methodical way. Yes, of course. Make sure you identify the dates, on which dates are very important. I'm just looking for some example. And I have an example which is important and interesting as well. Let's spend some 10 minutes more on doing this question. Without this question, this topic is incomplete. On 1st January 2001, Saunders Company had 2 million ordinary shares in issue. 1st January, 2 million. On 30th April, the company issued at a full market price 270,000. So 30th April was the first event, and we are issuing market shares at full market price. So only weighted average impact will come in, no bonus thing. On 31st of July, a second incident happened, which means that 7 months actually. it's not 30th of June, it is 30th of July, so 6 months down the line. The company made a right issue of 1 for 10 at a rights price of $2. The fair value of the share on the last day before that was 3.1. So market price was 3.1. We are giving 1 for 10 right issue at $2. And on 30th September, the company made a 1 for 20 bonus issue. So 3 events happened in this one question. One, you gave a full market value, FMV, then you gave a right issue, and last of all, you made a bonus issue. So 3 things we need to calculate. The last one will always be challenging. Okay. Profit for the year was 400,000. The reported EPS for year ended 31st December was 18.6. So profit was 400,000. The reported EPS for the year ended 31st December 2001 was 18.6. Last year was 18.6. This year you have 400,000 profit, and then you need to calculate the number of shares. So you had 2 million before, then you issued 270,000 of full value, plus you made right issue, plus you made bonus issue. So this is your new number of shares. So calculate the EPS for year ended 31st December 2001 and the restated EPS for the year ended 31st December 2000. So I'm going to calculate EPS for this year, and then I will restate the last year EPS as well. Okay, so how do we do that? EPS for the year ended 31st December 2001, they have already calculated, and actually workings are there. 400,000, they got this number of shares. How did they get the number of shares? What are they doing? This is their last year. Restated EPS, this is restatement of EPS 17.1 for that. So this actually solution has come in. We need to see the workings. Let me just put it like this. First, I need to calculate this thing. Very important thing. How did they calculate this EPS? Current year EPS, current year earnings, divided by number of shares. So this is very important. Once you get this number, then you had last year 18.5 or something. You will multiply with that bonus factor, the reciprocal. Bonus factor, reciprocal, you will multiply. So let's first see how to get this 2431. This would be interesting. Bonus factor would be easy. So 400,000 like this. So what happened? Initially you had, on 1st of January, you had 2 million shares. This is given in the question, but they remain there for only 4 months because you issued, when did you issue the shares? I think the date was 30th of April. 30th of April, January, February, March, April. So 200,000 shares, they remain with you for a period of only 4 months. 4 months period. So into 4 by 12, this is my weighted average. And bonus fraction was 3.1 divided by 3. How did I calculate this bonus fraction? Because we calculated our TERP, and TERP was 3. So price was 3.1, and no, market price was 3.1 before. So if actually we need to calculate here, TRPs first. First you see TRP. So you have here $10 into 3.1. This was the market price. You are giving 1 share into 2, which is for every 10 shares, you are giving 1 more share at $2. So 10 times 3.1 is 31. 1 times 2 is 2. So $33 is the value of 11 shares. So it means that before it was 3.1, now it is 3. So the price of the share has decreased from 3.1 to $3. So this is called your impact of that right issue. And now you are thinking, like, you might be thinking that why are we using the impact of this bonus in full market value in the beginning, this 4 months? Why are we using this in 4 months? I mean, bonus we gave somewhere on 31st of July, but why are we taking the impact of this time here? You know what? I tell you, you need to understand the bonus which you are giving or the right issue which you are giving. When are you giving right issue? Let me just explain you the dates. This is very important to understand. And you guys are accountants, right? I mean, we all are accountants, by the way, accounting and finance. We gave on 31st of December, you give someone a bonus of $12,000 in salary. So you have a staff member and you say that this year your bonus is 12,000. When do you record this? $12,000. You give it on in December. Do you think you give it on in December because of December's salary or because of December's performance? Why do you give this bonus?
Throughout the year performance.
Because of the performance throughout the year. And do you make, when you make your internal financial reports, what do? Do you put 12,000 in December? Or do you accrue it 1,000 every month?
We accrue it.
We accrue 1,000 every month. At the very beginning of the year, we already have an estimate that end of the year, this much would be the bonus or could be the bonus. And throughout the year, we are putting it in staff cost so that in one last month, it does not appear. Do you understand the concept? Now, what happens? We are giving actually, bonus issue, if you remember, is given here, right issue. Right issue is given somewhere here on 31st of July. 31st of July. But this is given for this particular period. So it should be impacted, or it should have an impact throughout the year, from the beginning to the end. So although we have 2 million shares, it is 4 by 12, but it has some bonus fraction as well. And bonus fraction is the reversal of that because it was 3.1 to 3. So you multiply it with the bonus fraction, you say the number of shares will be impacted, and into 21 by 20. What is 21 by 20? Because here you are also giving bonus issue. So here you gave right issue, here you gave bonus issue. And this bonus you are giving somewhere here. And it also impacts January, February, March, April, May, June. July, August, September, October, whatever it is. It was given on 30th of September. So this bonus fraction, this right fraction, and this is the time period. Both will be multiplied. Now, once I do this thing, I get a number 723. Although my shares are 2 million, but I would consider them as 723,000 shares. Then I move to the second thing, which is my 30th April. I made a full market price issue, 270,000. I would multiply, and this remains for only 3 months because after 3 months you have right issue. So again, I multiply them with the same numbers. So I take it 3 by 12, and I multiply them with the same thing, with the same bonus fraction for right issue and for bonus issue. I multiply them. But then on 31st of July, you are giving right issue. And if you notice that you only multiply it with 21 by 20, this thing comes in and this thing actually disappears. This thing you can thing, you see. This thing is gone 3/10 because 3/10 was right issue. 3/10 was right issue and this was bonus. So you are issuing right issue. So on that particular date, right issue you are giving, so that is gone. So right issue was gone, was given for this period. And here you are giving right issue, offering right issue. So you don't need to use the right issue fraction. It is removed. Only 227. How did you calculate 227 by 2497? Because you said 1 for 10. So this is the number of shares. This was 270 to 2270. This is 227 into 2497. So total number of shares are 2497. Now you are giving one for whatever. One for this, because this number into 1. So this number divided by 10. 2270 divided by 10, because 1 for 10 I'm giving. So 2.2 million 70,000 divided by 10 is 227. And when I give 227 plus this one, it becomes 2497. The base will change. The new shares will be issued on every one share for the last 10 shares. What was your right condition? Right issue condition was 1 for 10. How many shares you had before? You had 2.2 million shares, 2270. So 2270 divided by 10, I'm going to give 227,000 shares. But the total number of shares will be 2270 plus 227, 2497. So this is your number of shares fraction multiplied by 2 by 10. 2 by 10, because you gave bonus issue on, because after that you will have bonus issue here. So right issue, I'm just taking these 2 periods, 2 months. After 2 months, I will have bonus issue. So 2 by 12, because there were 3 instances, right? There was a full market value, there was a right issue, there was a bonus issue. This was 4 months, from 4 to here, this is 3 months, this is 2 months, and so on. And this time I used only 21 by 20, the bonus fraction. Right fraction I ignored. And when I come to the last transaction was on 30th of September, I'm giving bonus issue. Bonus I'm giving as, I don't remember now, 1 for 20. 1 for 20. So 2497. Now this 2497, the previous shares divided by 20, which makes me 124,850, and 124,850 plus 2497, total number of shares will be this much, and this remains for 3 by 12 because it is bonus issue. So this is gone and this is also gone. You don't need to show these two now because the past period has given. This fraction I'm using only for the past. This fraction I'm using only for the past. Past is gone now. I'm giving the bonus issue. I've already have taken it before. Now it is for future. So when you calculate this thing, you get 2431. This calculation, like I said before, it is challenging. You need to understand the time periods. The first, when you didn't have anything, after 4 months, you gave the right issue. You took only 3 months from right issue. No, here it is full market value to right issue and to bonus issue. This is 4 months from here to here. This is 3 months from here to here. This is 2 months, and from here to here, this is again 3 months. For this thing, I will use both of them, right and bonus issue factor. For this period, I will again use the both factors. For this period, I will use only one factor. For the last period, I will use nothing. And number of shares now are 2431. So if you go back and you see here, you had earnings. It was given in the question 400,000 divided by your weighted average number of shares. Your EPS becomes 16.5. Now, what was your last year EPS? If you go back and see, the last year EPS was given as 18.6. And I need to restate this EPS. So how do I restate? Multiply it with the reciprocal of the bonus factor. So 18.6 into reciprocal of, before it was 2120, now I'm doing 2021. So if you go back and see here you are multiplying it with 2120. You see 2120 and 3.1 divided by 3. But when you do restatement, you reciprocal, you change it. You not do it 21 by 20, you do it 20 by 21. One bonus factor, one bonus factor. This is the bonus factor for bonus issues. This is the bonus factor because of that theoretical exercise price of your shares. 18 points into this, your restated EPS is 17.1. So it says that although 18.6 is the EPS for last year, but if we had issued, or if we had these events of right and bonus issue last year, it would have been 17.1. So still your EPS is less, but it is not comparing this number, but you should be comparing this number. It is not, I mean, it's not improving, but it is not as worse also. Instead of 18.6, you compare it with 17.1, probably there would be less, disappointment. This table you need to see how to calculate this table. This calculation is important. Then you have diluted EPS.